We will start today's morning course. On today's morning course, we have the JEP Holdings, Keppel DC REITs, Singapore REITs Monthly, US Weeklies, and the China Weeklies. Move on to post for the JEP Holdings.
Thanks, Mike. We'll move on to today for our initiation on Friday by myself and Alvin on JEP Holdings. We initiate coverage with a buy and target price of 20 cents. Okay, just on the first page, just to give a bit of history, it was listed initially in 2004 under a company called Atlantec. The big milestone came into 2007 when they acquired this company called JEP Precision. Then they changed the name, and then that's where they under this JEP, that's where they started to pursue aerospace component manufacturing. The other big milestone was when they moved into their new 20 million facility in Seletar. The bigger event was in last year, I think, when UMS came in as a major shareholder, and a couple of months ago, they've actually made a general offer which has lapsed at 15 cents per share. It's conditional upon them taking control of more than 51%. In terms of the business model, I think 50 to 60% of the revenue come from aerospace component manufacturing. As you can see from the pictures here, probably more than that in terms of profit. The other type of products they produce is actually semiconductors, oil and gas, and trading. In terms of the types of products, you can see from here is the engine casing, some of the motors, parts of the motors, and also the landing gear components. Okay, in terms of the customers, for aerospace in particular, the landing gear will be for Safran, which is a French-based company. Then you have Collins Aerospace, which was acquired recently by the United Technologies Group, which is the owner of Pratt & Whitney. And also another major customer is Singapore Aerospace Manufacturing, which is part of which is a Temasek Link company. And the other customers are in oil and gas, you can see, and also semiconductor. Because the focus is on aerospace, so just to give you a flavor of the supply chain for aircraft components or aircraft. Of course, we all know these names are Boeing, Airbus. They are the ones who make the planes. But in terms of the engines, you have some companies like General Electric, Safran. Probably the one that has the largest share of taking the most popular will be the CFM engines, which is the joint venture between General Electric and Safran. Then the other ones will be like Pratt & Whitney. In terms of component makers, this is the segment which JEP plays in. You can roughly just separate them into the US component makers, then you got the European ones. These are all listed names, the Taiwanese and also the three big Japanese heavies, but aerospace is a smaller component for them. And in Korea, you got a company called Hanwha Aerospace. We will base our valuations from this particular segment. This table is just to show you some of the more popular engines. Like for Pratt & Whitney, they are famous for this GTF type engine. Of course, Rolls-Royce is the trend engine. In terms of our investment thesis, the outlook for the industry looks good. Obviously, there's an order backlog of 10 years, i.e. what it means that if you order a plane now, you probably have to wait 10 years to get delivery. As you can see from the table here, the backlog and in terms of units and years continue to climb. It's about 9 years now, and also likewise for Boeing, it's also around 10 years. Then in terms of the other reason why we like it is that since, as you know, JEP has the profitability has been quite meager or even loss making, but since UMS came in to take in management over the last 12 months up to the June most recent June earnings, you can see that actually earnings actually rose ninefold year on year. What they've done is basically to right size the workforce, i.e. cut labor, and then they also transfer some of the production to a lower cost Malaysia. And they also renegotiate some of the pricing of the contracts which were not so profitable. The other reason why we like it is that it's an attractive price point. Even at our target, it's only a 10 times PE, which is almost a 50% discount to the industry. We think this discount can narrow. And also the fourth reason is that, anyway, what's the downside? We have 15 cents kind of underwritten by UMS since they took make the offer at 15 cents in May, but obviously the offer has lapsed. In terms of this is our last slide. In terms of valuations, how we got a target price, there are very few direct comparables, especially on the SGX. So what we did was we just took all the component makers here And you can see that the industry trades around 20 times, the range about 12 to 20, 28. So we are initiating it at about 20 cents, which is about 10 times FYPE. And we just took 50% just because of the size. But we think this discount could narrow, I think, as they build up profits and size improves. Okay, that's it for me. Thank you. I'll move on to Natalie.
Okay, hi. So I'll be presenting on Keppel DC's third quarter 2019-2018, 2020 results. So the MPI and DPU was in line with our estimates. Quickly going through the operational performance, gross revenue was down by 2.5%. This is despite higher rental income from Capital KDC 5 in Singapore that was acquired on the 12th of June 2018. And gross revenue was lower, mostly because of lower overseas contribution from the depreciation of the respective currencies, Australian dollar, euro, GBP, and Malaysian ringgit. And there was also an absence of rental support. Actually, there was very little rental support. When KDC actually bought over KDC 5, the asset, there was a bit of rental support due to the asset being still in the ramping up phase. That means it hasn't stabilized. So this is the last quarter for the rental support. On the distributable income front, KDC actually entered into FX swaps to manage the FX exposure. So they actually hedge their overseas revenue or distributable income, 80% of it, and it was recognized in this line. So that's why distributable income was up by 5.4%. For DPU, it was also up 4.3%, and this is despite the enlarged share base. If you recall, in September, which is last month, KDC actually announced the acquisition of KDC 4 as well as One Net North, and they did a preferential offering as well as a private placement to fund this acquisition. So on the positive side, the ramp up in operations was more than able to make up for the fall off of the income support. Portfolio occupancy actually improved by 0.3 percentage points quarter on quarter, and currently occupancy is at 93.6%. So this improvement in occupancy came from Keppel DC 1, as well as Keppel DC Dublin, which if you recall in the first quarter, they actually underwent some AEIs to increase the power, as well as it was fully committed to 100%. On the negative side, the stubborn vacancy at in their Malaysian asset, which is the Basis Bay data center, the occupancy still stands at 63%. But however, this asset is actually a very small contributor. It only contributes 3% of the gross rental income. So for the outlook, KDC 4 as well as One at North will increase DPU by 22% from 7.8% to 9.5% cents. Sorry. So this is a very highly accretive acquisition. And for the placement, the private placement that was placed, it actually closed 9.3 times covered. The potential uplift from the conversion of, okay, so we actually raised our TP from $2 to 2.06, and this is because we raised our estimates by 2% to reflect the strong demand from data centers and the very little supply that is coming onto the Singapore market. And hence, right, there's actually a potential uplift because one of their assets in Singapore, which is KDC 5, there's actually a portion of the space that is not for data center use. So KDC is actually proposing to the government or writing in to get approval to convert the rest of the space, about 15.8% of the non-DC space that is currently vacant, to DCs. That means bringing on more power for the asset. And so there's a potential uplift from that as well. So with that, all right, our DPU yield is about 3.8% for FY19 and 4.5% for FY20. Moving on to the Singapore REITs Monthly. So year to date, the SREIT index was up 25.8%, and it has outstripped the STI as well as the real estate index. And with such high valuations, the yield, or rather the dividend yield spread, is currently at the negative 1.5 standard deviation range. The 3 months SOR actually fell. So year to date, it has fallen about 40 basis points. And in this low interest rate environment, it's actually highly conducive for the REITs. And we see a lot of acquisitions coming through, especially in the second half of the year. So year to date, about $6.7 billion has been raised to fund acquisitions through equity fundraising, such as private placements, as well as preferential offerings. The low interest rate environment is very conducive for REITs because they can borrow lower, let's say at 2%, and then use the proceeds to acquire an asset that yields maybe around 4 to 6%. So moving on to the subsector outlook, we only have the data for retail sales index, as well as the hospitality data coming for this month. Retail sales, it has been negative for for all of this year, as you can see, but the saving grace is the F&B index, which has been positive throughout the year, and in August it was actually up 2.9%. The SG the hospitality data is actually quite promising for the second half of the year. For 3Q, and last month we saw tourist arrivals actually increase substantially, and this one is up again. So it's about up by 3%, and last month it was up 4%. And we actually mentioned previously that there's tapering hotel supply coming onto the Singapore market. However, the softer economic outlook has actually dampened the average daily room rates, but then this is actually getting better, especially for we see it like increasing sharply for the last 2 months. So hotel room rates are up by 4%. On the right, you see our table of our calls, and just a quick wrap up. We feel that the price to NAVs will continue to remain high, especially because of this lower interest rate. However, we feel that the price to NAV is well supported by investors' appetite for yield instruments, as seen by the high subscription rate for all the placements, and the placements that have gone through in the last 3 months. They've closed in the range from 1.2 times covered to 9.3 times. 9.3 times is the Keppel DC's take-up rate for the private placements. Okay, with that, I will just flash through our Singapore, the SREIT universe. And then I'll move on to Edmund for US Weekly.
Hi, thank you, Natalie. So moving forward, I'll be talking about the US Weekly. So for the sector performance last week, you can see that most of the sectors are up, and this is mainly led by the consumer staples and the information technology sectors. This is despite the fact that there was mixed bank earnings. But year to date, we can see that the sectors that has performed the best will be the financials and the real estate sectors. So going forward for the next 2 weeks, there will be more earnings results, and we look for that to give us more clarity on whether the economy is really slowing down. So this is a list of the earnings results release dates for this week. Okay, so next I'll be talking about Cisco. So for Cisco, we see 3 reasons to buy, and it is currently trading at a PE ratio of 17 times. And we think the multiple is rather attractive given its long-run revenue growth opportunities. We are also impressed by its ability to continuously innovate new products for its networking switches and security. So the first will be the fact that it has a lot of recurring software revenue. So this software revenue is the most resistant business segment during the global financial crisis. So although Cisco has high exposure to the enterprises, but we believe this portion will help to shield its earnings from the lower demand from web scale and service providers in the short term. So if you view it on a 2-year average basis, the software order growth has remained very strong at 4% and is likely to achieve mid-single digit revenue growth in the long term. Secondly, we believe that there is strong product growth in switching and security. So product revenue was up 7% year on year in 4Q 2019, and we see double-digit growth due to the strong demand from Catalyst, which is campus and data centers. Security revenue was also up 14% year-on-year, which marks the sixth consecutive quarter of double-digit growth, and we believe that it is likely to continue until the end of this year. So in terms of the trade war, Cisco mentioned that they are banned from a lot of deals with the service providers and enterprises in China due to the trade war, but we think it is very unlikely to affect the top line for Cisco, because it only accounts for less than 3% of the FY18 total revenue. So I have come to the end of my session, and I'll pass on my time to Jie for the China Weekly.
Thanks, Edmund. I will give the summaries of the stock performance on China market. For last week, the CSI 300 dumped 1.08 last week. Shanghai Composite and Shenzhen Composite also dumped more than 1%. The reasons behind that, we think, is because of the China's released CPI number last week. It touched 3%, which is the tolerance point of the PBOCs. But we think the CPI touches 3% won't affect the China's focus of the monetary policies, mainly because of the on this times the CPI surge, mainly because of the mid price surge over 15%, and the core CPI still remains at 1.5%. And also, the China government already gave the scenarios for if the CPI touch the 3% and the 3.5%. In that scenarios, the China government will give the subsidiaries to the pork producers and the consumers. Another major macro indicators released last week is the new increased loans. For the new increased rooms, we are seeing that it starts to pick up on the second quarters, and the loan demands to continue to increase. Also, we observed that China's banking sector's valuation still remain low. The P ratios to remain as remains lower than the historical average, and for the PB ratios, this still remains in the cheap. This is a list of the China's diversity banks, and is the dividend. We calculated the dividend yield. The dividend yield remains at average 4.4%. This is a list of the upcoming earnings released on this week. We have several China major banks the earning released coming this week. The Ping An Bank and the China's constructions the banks will release the third quarter's result on the October 23rd. That's all for today's weekly sharings. If you have any questions, please type your questions on the chat board.
Hi, there's a question on whether we can comment on the US indices. Unfortunately, our technical analyst is currently not here, but the Dow Jones and S&P have already broken new high. And for Dow Jones, I think previously it has reached 27,000. So currently we are waiting for more earnings results released for these 2 weeks to determine whether again whether the US indices will break new high, or whether if there's a weakness, indeed a weakness in the corporate earnings, that would likely result in a slight correction for the US indices. Thank you. Hi, there's a question on whether Cisco is likely to benefit from the 5G launch. So with the 5G launch, I think it will mean that the service providers such as AT&T and Verizon are going to spend more money on the infrastructure. So we believe that Cisco is likely to benefit because they will need to order more, they will need to upgrade their network switches, and they will require more campus services from Cisco as well. Hi, there's a question. Can you explain what is the surprise amount in the earnings table? So if you look at the third and the second and the third last columns, so it is basically at the prior period actual revenue minus away the prior period expected revenue, divided by the actual revenue. And the same calculation can be used for the EPS last period as well. So if it's negative, it means that the actual revenue did not manage to meet the revenue expectations. Okay, if there's no more questions, we're going to end our webinar for today. Thank you very much for tuning in, and we hope to see you again next week. Thank you.